Okay, the next major part of the chapter is uncollectible accounts. Okay, so you know that we've recorded this account receivable and this sales revenue. All right, so we included the sales revenue on our income statement at the time, and account receivable is currently on our balance sheet as a current asset, generally. All right, well, if we know that this is not going to be paid, or we can actually even assume that some of these account receivables aren't going to be paid, that needs to be reflected in my financial statements, because I'm conservative. All right, so I don't know how to spell it. The Conservatism Principle states that we would rather understate assets and revenue, or I'm going to say net income, rather than overstate them. All right, so we don't want to say that more is owed to us than what we really think is owed to us. And we don't want to say that we earned more money than we actually think that we earned. Okay? So we need to recognize this fact that not all the receivables are going to be collectible, and that we will have some sort of bad debt expense. Okay? So there are two methods. I hate when I just copy what they wrote. There are two methods for handling uncollectible accounts. I'm going to say for recognizing, or I'll just say for accounting for. Okay, the first method is the direct write-off method. All right, this method is typically used when account receivables are low and generally from credit-worthy customers. All right, and under the direct write-off method, you record bad debt expense and write off an account receivable, I'm going to say a specific when it is deemed uncollectible. Okay, so let's say in year one, I have an account receivable from R.J. Jones. Goodness. And sales revenue. All right, $10,000. Okay, so at the end of year one on my balance sheet, I have an accounts receivable of $10,000, and I have sales revenue on my income statement of $10,000. All right, so it looks like I earned $10,000. But the year comes and goes, and in year two, I haven't heard from RJ in like the whole year. He hasn't paid me any money, and I decide to write off his account because I can't get a hold of him or anything else. So I have bad debt expense. And I take off the account receivable. For 10. All right, so this is how you write off an account under the direct write-off method. Now, there are a couple problems with this. Okay, first of all, bad debt expense is not matched. Okay, and I did that in all caps on purpose. All right, bad debt expense is not matched with the revenue that it helped to generate. All right, the sale was actually in the previous year, and now I have an expense in year 2. So my net income really in year 2 is understated. All right, it's looking like I earned $10,000 less in net income, but really this bad debt expense came from year 1. So it's not matched. The matching principle is not being applied. Okay. And then also at the end of year 1, my assets are overstated. But it works okay if you have a low volume of account receivables and your customers are pretty credit worthy. All right, so for instance, let's say that I'm HEB in Kingsville. I don't sell on credit to anybody. All right, I have 0 credit customers that are comprised of people like you and me. All right, my only credit customers are the big ranches in the area. So like King Ranch, Armstrong Ranch, whatever big ranches there are, where employees come in and they buy groceries for the ranch and they're allowed to buy them on account. But I have very few, and then the odds of those account receivables not being paid are slim to none. All right, the Navy base might have an account, although they actually have their own commissary. But anyway, you get my drift. Okay. So the entries, let me just write the entries one more time. Direct write-off entries. All right, to write off an account and recognize bad debt expense. It's bad debt expense and account receivable. Then you might also have, let's say that RJ comes back. RJ shows back up in year 3 and he's made $1 million and he decides to pay me. And so if he comes back to pay me, I have to reinstate it. So I put reinstate after write-off. And to reinstate it, I just reverse the entry above. So I would put his account receivable back on. I would credit the bad debt expense. And then once again, since this is in year 3, it's messing up year 3's financial statements as well. And then I can record the cash and the account receivable just like normal. Okay, so that is the direct write-off method. I'm going to stop the video here, and I'm going to do another video for the allowance method. All right, one more thing on this one. The direct write-off method is the only method allowed for tax purposes. And that's because there's no estimation here. You're writing off an account. And you'll see when we do the allowance method that there's an estimation involved. And the IRS doesn't like you to estimate stuff so much. All right, on to another video for the allowance method.